Jonathan Hunt, MD and CEO of Syngene International Management, joining us to talk more about the numbers. Jonathan, thank you very much for your time. Your Q1 performance was pretty good. Break it down for us. How did the CRO, CMO segment actually perform?
But very much in line with the guidance we gave for the full year on a constant currency basis. For the full year, we're looking at high teens, and 19% is at the top end of high teens. And nicely balanced, actually. All the elements of the business grew. What we're starting to see play out, though, is the sort of longer strategic shape that I expect Syngene to have, which is to be more twin-engined than single-engined. We were formed as a research services business many years ago, and we've started to become balanced towards CRO and CDMO, and you can see that in the performance so far this year, and I think it'll be a trend for the next few years, which is that development manufacturing piece driving the business forward as well as research services.
Oh, well, yes, you're looking at diversifying and balancing the portfolio, and that's what is playing out as well. But, you know, one thing, Jonathan, in this number was the fact that there was a blip on the margin front. Both the EBITDA as well as gross margins contracted for you. What were the reasons of the same, and where do you see the margins headed?
Yeah, not a blip from my point of view, just what we expected to happen. So as you rebalance your business, as you see more growth coming from manufacturing, you'd expect there to be more things going through the raw materials line within the P&L. So that's perfectly predictable. If we look at the EBITDA margins year over year, pretty much in line with the same quarter last year, once you adjust for a small amount of hedging losses, you know, and that's not our core business. That just reflects what's going on in the Forex markets. So yeah, absolutely where I expected the margins to be.
No, so you expected margins and they are where you expected it to be. So talk to me about where do you expect the margins for the entire year? Are they likely to stay in the 28-29% range?
Oh, EBITDA a little bit ahead of that, actually, around 30% for the full year.
Okay, the other positive news we've heard from you was the clearance of Mangalore facility. What does that mean for the company and other inspections which are in the pipeline? Can you talk about them?
Oh, we're inspected almost daily in some part of our business, whether it's self-inspections, client inspections, or regulatory audits. We must have 70 or 80 inspections during any given year. So the answer to that is, yeah, there's always something about to be inspected. We're a highly regulated industry. On the specifics of Mangalore, it's a building block. It's an important toll gate and enabler for that business. We've now got the ability to go back out to clients and say this is a facility that the FDA's inspected. They're amongst the toughest regulators in the world. And if they think that your quality and operating standards are at the right level, that's quite a positive endorsement. But it doesn't mean anything immediately in terms of revenue. It just gives you the ability to go out and engage with your clients, and they can have more confidence that that's a good supply point. But it's part of the much broader strategy that I alluded to at the beginning of the first sort of question that we had, which is around rebalancing the business to become twin-engined, both CRO and CDMO. And Mangalore, small molecules is an important part of that, as is the biologics. And we did quite a bit in the quarter in the biologics space as well.
Yeah, you did a lot in the biologics space, and the building blocks that you talked about, one such building block is the multimodal facility that you've acquired from Stelis Biopharma. What's the timeline of the takeover, the amount involved in the entire recalibration and incremental gains that you expect from that?
So we haven't got the keys yet. I mean, the deal's due to close, I think, around about October, once we've been through one or two sort of procedural issues. And then we intend to actually invest some more capex in there quite quickly, about $10 million just to upgrade it, change it really to our needs. Remember, this facility was built by Stelis in response to the COVID pandemic. It was a vaccine facility. We're going to just tweak it and change it into an antibody facility. Very, very similar platforms, but one or two changes that need to be made. to make that operational. So I think the quickest we'd expect to sort of get to operational, being validated, ready to go, would be the beginning of the next financial year. So it's not really an issue for this year. But what it really does, and this is why I'd go back to the strategic context, is it just gives us a lot of headroom for growth. We've moved very, very quickly over the last 18 months in our biologics business from having quite a lot of spare capacity to being almost fully sold out. So we were starting to bump up against maximum operating capacity ceilings. And we planned anyway, it was in our CapEx guidance for the midterm for the next 3 or 4 years, to actually start building more expansion capacity organically. This just does all of that in one step. So we're bringing forward the CapEx expansion by 3 years. It brings a lot of capacity online at the beginning of next year, and then we'll have to grow into it. So the same pattern as previously. But it really de-risks the business because it means that we won't be turning any clients away because we're fully sold out.
Well, what about your land which you acquired in Hyderabad recently? What's the development plan over there, and how much capex would you be focusing on that parcel?
Well, that won't be for production. That's going to be research. So the other half of the business, that's land for the research operations in Hyderabad to expand into over the next 5 years plus. Recall it was just before the pandemic. So 3 years ago, we opened up in operations in Hyderabad for the first time. We've gone through 3 very quick, rapid phases of expansion, 3 different units. We're close to 900 or so staff there now from 0 3 years ago. And this just means that we've got a very clear runway for the next 1, 2, 3, 4, 5 years. We can build our own labs to our own designs in response to what we see as market demand.
And Jonathan, lastly, before I let you go, what are the monitorables you have on your radar in terms of the various pulls and pushes that are there for the industry?
We've got a lot of operational things, as we've just described, over the next 6 months to get up and running. So it's easy enough to do the deal and acquire the Stelis facility, turning it from that, re-equipping it, upgrading it and getting it operational is quite a lot of focused work, but I'm confident we'll get that done. And then on the research services side, we're just seeing a little bit of a reversion to sort of pre-pandemic demand levels. What we saw last year was an awful lot of catch-up growth on top of normal demand. A lot of our Western clients lost ground during the pandemic. They weren't in their labs. They came back to work last year and they really put the accelerator down to try and catch up. That's sort of normalizing. So I'm watching that trend. And then there's some of the geopolitics. There is a steady, it's not a torrent, but there's a steady movement towards people rebalancing their supply chains. And I think India is going to be a next net beneficiary of that. So it's a good base to be operating on in our industry.
Well, yes, India is definitely the best place to be in, given the fact that the entire globe is looking at recalibrating their supply chains. On that note, Jonathan, we let you go. Appreciate you joining us.